A Florida home buyer recently purchased a house where the previous owner paid $3,200 in annual property taxes. After closing, that bill jumped to $8,700. That $5,500 gap comes straight out of your pocket. Most homeowners miss this because of a specific proration line on the closing disclosure that uses an obsolete tax rate to calculate your credits. I will show you where it's hidden. There is also a $5,500 supplemental notice that arrives later, which your bank refuses to pay. By the end, you will know how to predict your actual tax liability to avoid a total escrow collapse, starting with the listing page illusion. When you browse a real estate listing, the tax history section often looks like a predictable, flat line. If the previous owner was paying $3,200 per year, it is easy to assume your budget should account for that same amount. However, that $3,200 figure is frequently a locked-in legacy rate, tied to the seller's long-term ownership and specific exemptions. In many states, the moment the deed transfers, the clock resets on those protections. You aren't just buying a house, you are inheriting a tax profile that is about to be dismantled by the county assessor. Relying on the seller's historical bill to project your future monthly payment is a fundamental miscalculation. The real mistake isn't trusting the listing agent, it is treating a historical receipt as a future guarantee. This discrepancy between what the seller paid and what you will owe creates an immediate structural deficit in your housing budget before you even unpack your first box. Taxing authorities in many jurisdictions do not automatically reassess every property every year, but a sale provides a public, undeniable data point: the purchase price. While some states like Virginia or Pennsylvania might not trigger an automatic reset, many local authorities review the sale and adjust the assessment to match what you actually paid. Imagine a scenario where a reassessment to current market value adds $1,600 to the annual bill. This happens because the county sees the gap between the old assessed value and your new high-water mark price. You might see this reflected in a notice of proposed property taxes that arrives months after you move in. This document is often mistaken for junk mail, but it is actually the first warning of a permanent shift in your cost of ownership. Beyond the market value adjustment, the transition from a capped seller to an uncapped buyer is where the most significant financial friction begins. In states with strict assessment limits, such as Michigan's uncapping process or Florida's Save Our Homes cap, the tax bill is artificially suppressed for long-term residents. When the home sells, that protection evaporates. For a buyer in this situation, the loss of a long-term assessment cap can result in a staggering increase, say $3,400, added to the annual liability. In Michigan, for example, the taxable value resets to the state equalized value, or SEV, immediately following the transfer. The seller's bill was a product of years of restricted growth, while your bill is a product of today's market reality. This uncapping is the primary engine behind the massive tax jumps that catch new homeowners off guard. You must check the current taxable value versus the state equalized value before closing. If there is a wide gap, that gap is a bill waiting to be mailed to your new front door. During the closing process, your settlement statement will show a line 4 tax proration. This is meant to ensure the seller pays for the days they own the home and you pay for the rest. The problem is that this proration is almost always calculated using the most recent available bill, the seller's $3,200 rate. If the county hasn't processed the new assessment yet, the seller effectively pays their share of the old, lower rate, leaving you to cover the massive jump later. You might receive a small credit at the closing table, but that credit is based on an obsolete number. It feels like a fair split in the moment, but you are essentially accepting a prorated share of a bill that is about to expire. Always look at the proration section of your closing disclosure. If it doesn't account for a pending reassessment, you are the one who will eventually bridge the financial gap alone. Many new owners believe their mortgage company handles everything through escrow, but the supplemental property tax bill is a different beast entirely. This bill is issued to cover the difference between the old assessed value and your new purchase price for the remainder of the fiscal year. Say you are hit with a supplemental bill for $5,500. Because this is a one-time adjustment for the gap period, many lenders do not automatically receive or pay these bills from your escrow account. If you ignore this notice, thinking the bank has it, you could face late fees and even tax liens. It is your responsibility to verify if your lender will pull funds from escrow for a supplemental bill or if you need to cut a check personally to the county treasurer's office. The most painful part of the tax trap is the escrow analysis. Your lender typically collects a portion of your property taxes with each monthly payment. When the new post-closing annual property tax hits $8,700, the bank realizes they haven't been collecting enough. Not only will they increase your future monthly payment to cover the $8,700, but they will also add a catch-up fee to fix the deficit from the previous months. This creates a double whammy. Your mortgage payment jumps significantly because the base tax rose, and it jumps again to repay the shortage. To avoid this, you can manually request an escrow analysis once you receive your new assessment, rather than waiting for the bank's automated system to find the error a year later. A common error that compounds the tax jump is failing to reapply for exemptions. Most jurisdictions offer a homestead exemption for primary residences, which can lower the taxable value. However, these do not always transfer automatically from the seller to the buyer. If you forget to file the paperwork by the county's deadline, you lose that protection. Even a small change, like an updated school district millage rate adding $500 to the bill, feels heavier when you are also missing your primary residence discount.